Hey guys, Omar Khan here with Theta Trading, and today's topic of discussion is going to be how does the stock market do after the start of a major war like we're in right now? So right now there is a conflict or a war in the Middle East, and that started roughly February 28th. There's also an ongoing war that started a few years ago between Russia and Ukraine. So we've got two major conflicts that are going on right now. Now, we want to take a look at how does the stock market form right after that war? Because it's an initial shock to the market. Market's like, oh, we weren't expecting this. And the market prices in today what it believes will happen in about 12 months from now. It's a forward-looking mechanism, okay? So right now, this war just started on February 28th. And what we're going to do, take a look, is we're going to take a look at the S&P 500. That is the largest stock market in the United States, 500 largest companies. And we're going to take a look at, since the start of that war on February 28th, how much did the market go down? And then what does history tell us? We're going to go all the way back to World War II and look at all the different wars and how they affected the markets initially and 12 months out, okay? Because that will make us a more informed investor. So when people say, well, how does the market keep going up? The market just keeps hitting all-time highs, even though we're in a war situation, even though oil prices continue to climb. But let's take a look at history. So I'm going to share my screen here, guys, and let's take a look at some statistical data. All right, so here we're going to take a look at going all the way back to impact of war on the stock market, what investors need to know. Okay, so pretty simple. Wars often lead to short-term stock market sell-offs, just like we had this year, but markets typically recover as the situation stabilize. Okay, and they've already done that this year. So defense energy stocks tend to perform well during wartime, benefiting from increased demand. Historical data shows that major geopolitical events often do not have a lasting negative impact on US stocks. That is the key. So, what ultimately drives a stock price higher or lower in the long run is going to be the amount of money that company makes or doesn't make. So, if the economy is doing well, people are spending money, companies are investing in their businesses, growing their businesses, that is the bigger determinant. So, geopolitical events do not have a lasting negative impact on US stocks, okay? So, global conflicts from Russia's invasion of Ukraine to the US war in Iran influence market sentiment and spark short-term volatility. Short-term volatility just simply means a sell-off. Volatility is a short-term sell-off. History shows that US stocks often rebound after initial sell-offs, highlighting the market's long-term resilience during periods of uncertainty. Now, the stock market doesn't like uncertainty. It wants to know what's going on. And when things are all rainbows and sunshine, it tends to go up. But when something gets thrown as a monkey wrench into the system, it tends to sell off. And then it gets used to it. It kind of says, okay, well, this will be over soon. It kind of prices it in, and then we resume. Okay, now keep in mind the S&P 500, the index that we're talking about, right? The broad market in the United States, on average, over the last 20 years, has gone up about 11% a year. So we know the market goes up over time, okay? Now, defense and energy and other security-related sectors usually see increased activity during, though market reactions can vary because of the war puzzle, where outcomes depend on whether a conflict is expected or arrives unexpectedly, and they're always unexpected. Generally speaking, you don't expect these things, okay? Now, we're trying to talk about the resilience of the stock market. War often brings about a level of uncertainty, okay? And again, like I said, the stock market does not like uncertainty. The outbreak or anticipation of war can lead to a sharp sell-off in stocks. We see that almost every time. Investors may move towards traditionally safer assets like gold, bonds, or currencies. So let's take a look quickly at the gold market. How's the gold market done? Well, here's the gold market, okay? So this is gold. Now, the war started here, right about here on February 28th, right there, okay? And gold has actually sold off since it. So that's just before that, $5,247 US per ounce of gold. So what the theory behind that is when things become uncertain, you want to get out of riskier assets, i.e. stocks, into safer assets like currencies, like bonds, like gold. But that didn't happen this time. As you can see, gold is actually down quite a bit since then. But if you look at gold, if I go to a 5-year chart here of gold, 5 years ago, gold was at $1,800. Now it's at $4,600. Even if I go to a 1-year chart here, gold was at a year ago, There we are, $3,200. Now we're at $4,600. So gold has had a considerable run up, and that could a lot of that could be because of the amount of money printing that occurred over the last number of years. Gold has a limited supply, whereas money can be printed out of thin air, and that's why we have something called inflation, right? Well, things go up over time, and that's because governments around the world can just make and print up money. Imagine you could do that at home. Just go to your printer and say, "Oh, I need a few bucks. Why don't I print some money up?" Well, what that does is that makes the value of existing dollars worth less. Gold has to be dug up. It's often stored. People don't sell it as often. So although it's not a finite quantity, meaning it's not a limited quantity, because more gold is mined every year, there is still a limit to it. You just can't print it as much as you like to, like we did during COVID. So gold actually did not go up during this period. So now let's go back and take a look and keep going here. Despite the initial negative reaction, stock markets have shown resilience over time. Okay, indeed, they often quickly recover as the situation stabilizes or as the scope of the conflict becomes clear. I think that's what's happened here. The scope of the conflict has become clear. This is a war that's not good for anyone. Why? Because it's pushing global oil prices higher, and that leads to higher prices and reduced economic activity. Now, 20 to 25% of the world's oil and natural gas flow out of the Strait of Hormuz, okay, which is the area that is, under contention here. Now, a lot of that oil flows to Asian countries, China, Japan, South Korea, Australia, although Australia is not Asian, Southeast Asian countries like Malaysia, Indonesia. They are very heavily reliant on Middle Eastern oil, okay? And if that's blocked, what happens? Well, they have an energy shortage. That means prices start going up. That is not a good thing for the stock market, nor is that a good thing for the consumer or people's well-being. So you're going to get a lot of pressure exerted on the on to get this resolution, to get this resolved, excuse me, from countries like China, like Japan, South Korea. They're going to say, hey, look, our citizens can't afford these higher oil prices. It's causing food prices to go up. It's causing all kinds of chaos. We need this, and also we need to get this. We need to get this war over with and get oil prices back down again. Also, Europe. Europe is very heavily reliant on Middle Eastern oil as well, and gas prices in the European Union have gone up considerably since the start of this war. Now, the stock market, why is it an all-time high? How does this even make any sense? Well, we're going to keep going and take a look at why the stock market is all-time high and why it can go a lot higher from here. Okay, so LPL Financial Research notes that stocks have largely shrugged off past geopolitical events as serious as the escalation is. Previous experiences have indicated that it may be unlikely to have a material impact on U.S. economic fundamentals or corporate profits. That's the key. Okay? As serious as the escalation is, previous experiences have indicated that it may be unlikely to have a material impact on U.S. economic fundamentals and corporate profits. Now, remember what I said, what makes a stock go over a long term is the amount of money a company makes or doesn't make. So it doesn't have a huge impact on the amount of money the companies are making, especially in things like IT. Okay, so a lot of the buzzwords right now, a lot of the spending we're seeing, we're starting to see artificial intelligence become a larger and larger part of our lives almost on a daily basis right now. I know, everyone is starting to use AI, businesses starting to use AI, jobs are being cut because of AI. That leads to increased productivity, increased corporate profit, okay? Now, where will things suffer? Gas prices will go up. People may not spend as much on vacations. Food prices will go up. They might not go to the movies as often, maybe buy lower priced gifts. Things like that will be affected. But generally speaking, these shocks don't last for a long time. And I told you before, the stock market's looking out 12 months. Okay, so now let's go to history. Okay, let's see what history tells us. Okay, we're going to go and take a look at Russia. This is the last time it happened. Another example is after Russia invaded Ukraine in 2022, which rattled global markets. Nobody was expecting this, right? In the U.S., the S&P 500, which we're looking at, which we're comparing to, fell more than 7% in the days and weeks immediately following the incursion as the U.S. and other nations stepped up severe economic sanctions on Russia, and investors worried about the impact of commodity prices, gas. But a month later, markets had rebounded, and the S&P was trading higher than before the invasion, even as the price of oil remained above $100 a barrel. So oil is also now above $100 a barrel. We're right around that $100 mark, and oil has seen a considerable rise. You can tell by just, when you go drive a gas station, oil prices, gas prices are up. People are spending more. That means they're going to have less money to spend on something else. So this Russia-Ukraine situation is very similar to what we're going through now. And I'm going to show you another example. This one's a more dire example, but we're going to take a look at past examples. Okay, so this was 2022. How did the market do? Okay, so there's the invasion. As you can see, we had a pullback. Pullback was about, we went from 4,400 here and the pullback, and you can see around March 14th, it was around 4,100. So you had about, 8% or so, 7% pullback or so. So 7%, okay, in the days and weeks immediately following the incursion. 7%, that was the amount that the market went down because also it was all of a sudden surprised. How did this happen? When did it happen? What are the impacts? And the stock market, like I said, doesn't like uncertainty, so it's sold off. People go into safer investments, bonds, stocks, gold. Sorry, bonds, currencies, and gold. Okay, so we had a sell-off here, but let's take a look at what's happening now. Where is the S&P? Now, this was 2022. Look at the S&P now. 7,230. Where were we here? 4,384. So in the course of 4 years, we're up almost 70%, or around 70%. That's a huge increase. Now, if I go back to the 5-year chart here, we can take a look in the S&P right here around 2022. Right here is when the conflict started. 43.84 goes down, and then bam, it just picked up from there. Now you've had pullback since then, but look at how well the stock market has done since then. This is why when you get an opportunity in the stock market, the market pulls back. Remember, the market goes up over the long term. Don't panic. Wait it out. Be calm. Be patient. Understood that you bought good companies. Hang around, wait. And if you have more money, that's when you want to get aggressive. Okay? As long as you're in it for the long term. If you're looking to make a short, quick buck, who knows what could happen. Now I'm going to pivot back and let's take a look at some history of how the markets have performed after. Okay? So here is examples going back all the way back to Pearl Harbor. So basically World War II. That was an unexpected event. The Japanese attacked the U.S. naval fleet in Pearl Harbor in Hawaii, and the market, the S&P 500, went down 20%, 19.8%. Look a year later, up 11.4. Hungarian uprising, Cuban Missile Crisis, that was a big one. Okay, down 6.6. Next year, a year later, up 32%, 32.1. Kennedy assassination. John F. Kennedy was shot and assassinated in 1963. Initially, the market went down 2.8%, and a year later, up 27.8%. Now, the outlier here I want to show you, let's look at a couple of examples. Here's the outlier, the Yom Kippur War of 1973. And this is why we have to pay particular attention to oil prices, okay? This was the Arab oil embargo. The Arabs basically said, Saudi Arabia in particular said, hey, look, fine, we're not going to ship oil to you guys anymore. Oil prices went through the roof, which caused something called stagflation. High inflation, price of goods and services went up quite a bit, and a stagnant economy. That was the outlier, down 41%. That probably won't happen. We have a lot more suppliers of oil globally now than we did in 1973. And I think that everybody will have this resolved because it's not in anyone's best interest. And the allies of both countries, the European allies of the United States and the Asian allies of Iran, will both be exerting a lot of political influence saying, hey guys, get this over with, come to a resolution, we need to get on with business. And the stock market understands that, okay? Now, Iraq's invasion of Kuwait. So this is the one to watch out for. If we have a protracted long-term disruption of oil, it could get messy, right? But obviously the market does go up over time. It could get messy in the short run. But what we're doing right now is we're buying, and we keep buying because we know what history tells us, okay? Now, Iraq's invasion of Kuwait. This is 1990, and market initially went down by 16.9, but a year later, up 14%, okay? September 11th, down 11.6, and then a year later, it was also down 11.2. Now, the reason for that is because that was accompanied by the dot-com crash of 2000 to 2002. And this was kind of in the middle of that. So that was an economic recession. So there are a couple outliers, but as you can see, basically, um, the stock market does really well. Now, if we look back at the Israel-Hamas situation that was started here in October of 2023, down 4.5%. Look at that, 35% up a year later. Okay, the S&P 500. Now, the two that we have going on right now is the Israeli airstrikes on Iranian nuclear strikes and the U.S.-Iran war. Those are ongoing. Now, let's take a look at how the S&P did, okay, and how it's done. So this started on February 28th, okay, so here we are, February 28th. The S&P is at right here. There we go. 68.78 approximately. Okay, now we're at 72.30. So initially, yeah, we had that decline, and that's what we just saw. History tells us that we're going to have that initial decline, and we did. Okay, so we had that initial decline, and that decline was about 5% right here. Okay, markets went down 5%, and bam, the markets kind of got used to it, and look at that rally since then. The markets are up almost 20% since this low of March 30th. So just because something like this happens doesn't mean the markets can't go higher. So what did we do? Well, we were buying as aggressively as we could as the market was going down. Now, it could have gone down further. It could remain down. But we just witnessed this. History tells us that a year later, the stock market, generally speaking, is in pretty good shape. And this should be used as a buying opportunity. Guys, I hope you guys like that video, and I hope it makes you a more well-informed investor. If you like these videos, hit that like button, share with friends and family, and subscribe to our channel for further videos. Thanks, and we'll talk to you soon.